In 1973, a young surgeon made $50,000 a year, the equivalent of $300,000 today. He wore second-hand clothes and drove a modest car that he kept for 15 years. Down the street, a janitor named Ronald Reed quietly went about his work at J.C. Penney, earning just above minimum wage. He spent his free time chopping wood and reading the Wall Street Journal. By 2014, that janitor left $8 million to his local library and hospital. The same year, the surgeon filed for bankruptcy. Money, it turns out, has little to do with your smartness. And everything has to do with how you behave. Morgan Housel discovered this after spending over a decade studying the intersection of finance and human psychology. His findings reveal patterns that have shaped the financial destinies of millions, from Wall Street titans to everyday workers. The story begins with a simple truth: we think we make rational money decisions. But our choices are driven by experiences so personal and so deeply embedded in our past that we rarely recognize their influence. Take Bill Gates and his friend Kent Evans. Both brilliant and passionate about computers, they attended the same high school and had rare access to computing in the 1960s. One would go on to build Microsoft, but the other's story took a very different turn. What separates their paths, and what it means for how we think about wealth, forms the foundation of a much larger narrative about success, risk, and the true price of financial freedom. The difference between Gates and Evans came down to something we rarely discuss in finance: chance. While Gates went on to transform personal computing, Evans met a tragic end in a mountain climbing accident before graduating high school. 1 in a million luck colliding with 1 in a million risk. This pattern, how random events shape our financial lives far more than we care to admit, appears consistently throughout modern history. Consider Jesse Livermore, one of the greatest stock traders of the 1920s. In 1929, as the market crashed and fortunes evaporated, Livermore made the equivalent of $3 billion in today's dollars in a single day. Yet 4 years later, he lost everything, not because his strategy changed, but because he pushed his success too far. The same year Livermore triumphed, a successful real estate developer named Abraham Germansky walked through Wall Street, tearing strips of ticker tape into pieces as he headed toward Broadway. He was never seen again. These weren't isolated incidents. They reveal a fundamental truth about money that most of us struggle to accept: getting and keeping money requires two completely different mindsets. The real challenge isn't earning money, it's the ability to keep it. This brings us to Warren Buffett, perhaps history's greatest investor, but not for the reasons most people think. By age 30, Buffett had accumulated $1 million in today's dollars, a significant sum but not extraordinary. What made him extraordinary was what happened next: the decades of patient compounding, the refusal to interrupt the process, the understanding that time is the greatest force in finance. But Buffett's real genius wasn't just waiting, it was something more subtle. Of the $84.5 billion net worth he accumulated, $84.2 billion came after his 50th birthday. $81.5 billion came after he qualified for Social Security. Let's pause on that for a moment. History's greatest investor isn't great because of what he bought. He's great because of what he didn't do. He didn't interrupt the process. While others frantically traded in and out of positions, Buffett simply let time do the heavy lifting. Compare this to Jim Simons, head of Renaissance Technologies. His fund has compounded money at 66% annually since 1988, 3 times Buffett's rate of return. Yet Simons' net worth is $21 billion, roughly a quarter of Buffett's. The difference? Time. Simons didn't start until he was 50 years old. This brings us to a crucial insight about wealth that most people miss entirely. Look around your neighborhood. The biggest house might belong to a neurosurgeon. A business owner might drive the most expensive car. But true wealth? True wealth is what you don't see. The millionaire next door might be driving a 10-year-old car. The person with true financial independence probably lives in a modest house. Because wealth isn't about what you spend, it's about what you keep. Consider Ronald Reed, our janitor from earlier. He lived in a $12,000 house he bought at age 38. He drove used cars. His main hobby was cutting wood. But beneath this modest exterior, he was quietly accumulating shares in companies like AT&T, Bank of America, CVS, Deere, GE, and General Motors. The question isn't why some people get rich while others stay poor. The question is, why do so many people who get rich also go broke? The answer lies not in investment strategies or market timing, but in something more fundamental: our relationship with greed, fear, and the endless tug-of-war between enough and more. Consider Rajat Gupta. Born in Kolkata and orphaned as a teenager, he rose to become CEO of McKinsey, one of the world's most prestigious consulting firms. By 2008, he was worth $100 million. That's $5,000 an hour, every hour, even while sleeping. He had everything. But it wasn't enough. In 2008, as Goldman Sachs faced the financial crisis, Gupta learned Warren Buffett planned to invest $5 billion in the bank. As a Goldman board member, I found this information confidential. 16 seconds after hanging up from the board meeting, Gupta made a phone call that would destroy everything he'd built. The same year, Bernie Madoff's $65 billion fraud unraveled. But here's what most people don't know. Before the Ponzi scheme, Madoff ran a legitimately successful trading firm, making between $25 and $50 million annually. Both men had reached the pinnacle of success. Both had more money than they could spend. Yet both risked everything because they didn't know when to say, "I have enough." This reveals something profound about money. The highest form of wealth is not about having the most. It's about having control over your time, about waking up and saying, "I can do whatever I want today." Bill Gates understood this early. When Microsoft was young, he kept a year's worth of payroll in cash, despite the opportunity cost. Warren Buffett expressed similar thinking when he told shareholders, "I will not trade even a night's sleep for the chance of extra profits." Today, we live in a world where comparison is constant. Instagram shows us everyone's highlight reel. LinkedIn broadcasts every career victory. But remember, the NBA player who goes broke and the janitor who dies a millionaire are playing entirely different games. The question isn't, how do I get rich? The question is, what game am I playing? Because doing well with money isn't about what you know. It's about how you behave. In 2007, economists at the Federal Reserve made their prediction for 2008. These were some of the brightest financial minds in the world, with access to data most can only dream of. Their forecast ranged from 1.6% to 2.8% growth. The economy contracted by more than 2%. Even the world's leading economists, trying to predict just months into the future, were wrong by orders of magnitude. And yet, everyday investors routinely make decisions based on forecasts stretching years into the future. The 2008 financial crisis wiped out $8 trillion in household wealth. But here's what's fascinating: when an alien observing Earth would look at our planet in 2007 versus 2009, they'd see virtually no difference. The same buildings stood, the same factories operated, the same workers had the same skills, and the same technologies existed. What changed wasn't our capabilities, it was the stories we told ourselves about the economy. This brings us to a crucial truth about money: we're not purely rational beings making calculated financial decisions. We're humans, driven by emotions, narratives, and the experiences that shaped us. Someone who lived through the Great Depression sees cash differently than someone who came of age during the 1980s bull market. Someone who grew up poor thinks about financial risk differently than someone born into wealth. Neither is wrong, they are both responding to life's lessons. This is why the best financial advice isn't about finding the highest returns or the cleverest tax strategies. It's about balancing making money and sleeping well at night. Consider a simple example. At the peak of his success, entrepreneur Charlie Munger was once asked about his investment strategy. His response was telling: "I have lived a long life deliberately trying to let my errors stay within a reasonable circle of competence." What Munger understood, and what most miss, is that financial decisions are not made in spreadsheets. They're made at dinner tables. They're made in conversations with our spouses. They're made while watching our neighbors buy bigger homes and newer cars. Take the housing market of the mid-2000s. On paper, paying $700,000 for a two-bedroom home in Florida made little sense for a family planning to live there for decades. But for someone planning to flip it in 6 months in a rising market? The math looked entirely different. This explains why, in 2004, the number of houses being flipped, sold twice within 12 months, rose from 20,000 to over 100,000 per quarter. Different people play different games with various rules. After World War II, the American consumer emerged into a world of unprecedented opportunity. 16 million veterans returned home. The GI Bill offered mortgages with no money down. Consumer credit exploded. For the first time in history, the average person could borrow to live a better life today. The results were staggering. Between 1945 and 1980, median income doubled and then doubled again. But something else happened, too. Expectations changed. Americans began to believe that living standards should be roughly equal, regardless of occupation. This belief persisted even as reality changed. By the 1980s, income inequality began growing dramatically. However, the cultural expectation of lifestyle equality remained. The result? An explosion of household debt as people stretched to maintain lifestyles their incomes could no longer support. Consider this striking fact: the median American home has more bathrooms than occupants. Not because we need them, but because of the stories we tell ourselves about success. History never repeats, but human behavior reliably does. By 2007, household debt reached levels never seen before, not because Americans suddenly became reckless, but because they lived by rules established in a different era. The median wage earner in 1960 could support a middle-class lifestyle for a family of 4. By 2020, that same lifestyle often required 2 incomes and significant debt. The numbers changed, but our expectations didn't. This brings us to perhaps the most important lesson about money: the gap between expectations and reality shapes almost every financial decision. A young lawyer earning $300,000 might feel poor watching her peers buy luxury cars and vacation homes. Meanwhile, a teacher earning $50,000 might feel wealthy, having grown up in a household that earned half that amount. Same numbers, different stories. This is why Morgan Housel emphasizes something counterintuitive: the most important part of building wealth isn't your rate of return. It's your savings rate. It's the gap between what you earn and what you spend. Consider 2 extremes: the investment banker who earns millions but spends it all, and the school teacher who has saved diligently for 30 years. By retirement, the teacher might be wealthier, not because they earned more, but because they understood something profound: wealth is what you don't see. Take Michael Moritz, the billionaire head of Sequoia Capital. When asked about his firm's success, he didn't talk about brilliant investments. Instead, he said, "We've always been afraid of going out of business." This fear, this constant awareness that things can go wrong, isn't paranoia. It's preservation. This paradox, being optimistic about the future while paranoid about what could go wrong, defines many of history's most successful investors. Like Navy pilots who spend thousands of hours training for rare emergencies, they prepare for the worst while hoping for the best. Consider Rockefeller's approach to business. He was one of the wealthiest people in history, yet he rarely spoke. When asked about his silence during meetings, he would recite, "A wise old owl lived in an oak. The more he saw, the less he spoke. The less he spoke, the more he heard." Why aren't we all like that wise old bird? Today's world moves faster than ever. We have access to more financial information, investment options, and opportunities than any generation before us, but the fundamental truths about money haven't changed. The person who saves carefully and invests patiently still has an advantage over the person who is always chasing the next big thing. The investor who stays in the game, avoiding catastrophic mistakes, still outperforms the one seeking perfection. Think about this: who benefited the most from all the investors who owned Berkshire Hathaway stock during Buffett's tenure? Not those who bought and sold cleverly, but those who simply never sold. The same pattern appears everywhere in finance. The highest returns tend to come not from brilliance but from patience, not from knowing more but from doing less. This brings us full circle to our janitor, Ronald Read. He never made a single brilliant investment, never timed the market perfectly, and never had inside information. What he had was better: the patience to let compound interest work its magic over decades. In the end, Ronald Read's fortune wasn't built on financial genius. It was built on thousands of small, consistent decisions over decades. Each dividend is reinvested. Each market crash survived. Each temptation to spend was resisted. This is perhaps the most powerful lesson about money. Success doesn't require a high IQ or unique insight. It requires patience and self-control. The ability to watch others get rich quickly and still stick to your own pace. Consider this striking fact. The stock market has returned about 7% per year after inflation since the 1950s. Keeping pace with that average would turn modest savings into significant wealth over a lifetime. Yet most investors don't get these returns. Not because they're not smart enough, but because they can't resist the urge to change course. As Morgan Housel puts it, the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today. This isn't just about money. It's about freedom, the freedom to make choices, the freedom to say no, and the freedom to wait for better opportunities. Think about the surgeon from our opening story. He had the income but not the mindset. The janitor had less income but understood something deeper. True wealth isn't about what you can buy. It's about what you can afford not to buy. In the end, the psychology of money isn't about mastering complex financial concepts. It's about mastering ourselves, understanding our own behaviors, tendencies, and stories about money. Because the most important investment returns aren't measured in dollars but in good sleep. In family dinners, uninterrupted by work calls. In the ability to bounce back from life's inevitable setbacks. These truths about money reveal themselves across every generation, through every market cycle, in every country. Yet, each generation must learn them anew. The tech executive who threw gold coins into the ocean for amusement eventually went broke. The humble janitor who lived below his means left millions to charity. Their bank accounts told one story, and their behavior told another. There are only 3 ways to maintain wealth. Live below your means. Accept that the world is uncertain. Be patient. Everything else, the investment strategies, the market timing, the hot stock tips, is just noise, dangerous noise that can lead us astray from these fundamental truths. Remember that couple in the expensive car, the big house, and the luxury vacations? We can't see their bank statements, stress levels, or sleepless nights. What we see isn't wealth, it's consumption, and consumption is the opposite of wealth. When asked about his success, Bill Gates once said, "Success is a lousy teacher. It seduces smart people into thinking they can't lose." This applies to everyone who touches money, from billionaires to daily wage workers. Money's greatest power isn't in what it can buy, it's in what it can prevent: stress, worry, and the feeling that you're one bad decision away from disaster. The janitor understood this. So did Buffett. So did the countless quiet millionaires living in modest homes, driving modest cars, and making modest choices that add up to extraordinary outcomes. They understood that building wealth isn't about taking big risks. It's about taking little risks, over and over, for a very long time. Not about being the smartest, but about being the most consistent. In the end, Morgan Housel leaves us with a profound truth: our relationship with money isn't about math. It's about our personal history, our fears, our hopes, and the stories we tell ourselves about what money means. Think about your own story with money. The lessons you learned watching your parents. The financial wins that gave you confidence. The losses that taught you caution. These experiences shape your decisions far more than any textbook formula ever could. The most powerful lessons about money are often the simplest. Save a reasonable portion of what you earn. Let time be your ally. Leave room for error. Accept that you might be wrong. But simple doesn't mean easy. Just as a diet book's advice to eat less and exercise more is simple but challenging, these financial principles test our emotional discipline rather than our intellectual capacity. Remember, every financial decision is a trade-off between the present and future you, between what you want now and what you want most, between the life you see others living and the life that lets you sleep at night. The richest person does not have the most but needs the least. Freedom, it turns out, is about much more than a number in your bank account. It's about having options. About being able to say no, about choosing your own pace in a world that's always pushing you to go faster. As we close this exploration of money's psychology, perhaps the most valuable question isn't how can I get rich, but rather what kind of life do I want money to give me? Because, in the end, money is just a tool. And like any tool, its value lies not in itself, but in how we use it to build the life we want. If this journey through the psychology of money has resonated with you, take a moment to reflect on your relationship with wealth. Are you playing someone else's game or building a financial life that aligns with your values? Share your thoughts in the comments below. What's your story with money? What financial wisdom has served you well? Your experience might be exactly what someone else needs to hear. If you find value in these insights, subscribe to our channel. Every week, we explore powerful ideas that can transform your understanding of money, wealth, and what it means to live a truly rich life. Hit the notification bell to join us on our next deep dive into the fascinating world of finance and human behavior. Understanding money isn't just about numbers, it's about understanding ourselves. Remember, building wealth is not about knowing more. It's about behaving better.